Risk and money management. This content is for educational purposes only and should not be considered legal, tax, financial, or investment advice. Trading involves risk and may not be suitable for all investors. Always consult with a qualified professional before making financial decisions. Past performance does not guarantee future results. You could lose more than your initial investment. This material does not qualify you for certification or licensing in any industry and is not intended to prepare you for employment. Use the information provided at your own risk. 1. Why so important? 2. How much to risk? 3. A good set of rules. 4. Setting rules for trading plan. 5. Managing trades. 6. Risk-reward ratio. 7. Stop loss. And 8. Trailing stop loss. Be fearful when others are greedy, and greedy when others are fearful. By Warren Buffett. Why so important to have a set of rules? As traders, our primary goal is straightforward: protect our capital. But how do we achieve this effectively? The answer lies in one key principle: having clear, defined rules that guide our trading decisions. Let's consider the alternative: trading without rules. Imagine facing consecutive losses. Naturally, frustration sets in, and the urge to jump back into the market to win it all back becomes overwhelming. This is known as revenge trading, and it's one of the fastest ways to make a bad situation even worse. This is where our rules come into play. They serve as critical guardrails, reminding us of our limits and protecting us from acting impulsively. For example, if we reach a certain loss threshold, our rules might dictate that it's time to step away from the market. This pause is essential. It gives us the opportunity to cool down, re-evaluate, and return with a clear mind. Trading can be intense, and emotions can easily cloud our judgment. But by adhering to our rules, we maintain discipline and protect our capital. This allows us to trade strategically, not emotionally, positioning ourselves for long-term success rather than short-term gains driven by emotional reactions. Key points. Protect your capital. Your capital is your most valuable asset as a trader. Make sure you prioritize its preservation by following clear and defined rules. Avoid revenge trading. Don't let frustration cloud your judgment. If you experience losses, resist the temptation to jump back into the market impulsively. Revenge trading only leads to greater losses. Maintain discipline. Stick to your trading rules, no matter how emotionally charged the situation may be. Discipline ensures you trade strategically, not emotionally, and positions you for long-term success. How much ideally you should risk? In trading, one of the golden rules is to limit your risk on any single trade to just 1% of your total capital. But how does this work in practice? Let's say you have £1,000 in your account. With the 1% rule, this means you're risking only £10 on each trade. This small risk gives you a safety net, allowing you up to 100 trades before your capital is fully depleted. Even if you lose some trades, you're still in the game, able to seize new opportunities as they come. Now, here's an important aspect of the 1% rule: as your account balance fluctuates, so does the amount you risk per trade. For instance, if your capital drops to £800, you would now risk just £8 on the next trade. This adjustment helps stretch your remaining capital, allowing you to make more trades and stay in the game longer during a losing streak. Similarly, if your capital increases to £1,200, you'd risk £12 per trade, maintaining the same 1% risk principle. This dynamic adjustment keeps your trading plan consistent while giving you more flexibility with your growing capital. On the flip side, as your capital increases, the percentage you risk per trade should decrease. Why? Let's consider this example. If you have £1 million in your account and follow the 1% rule, you'd be risking £10,000 per trade. Now, imagine hitting a losing streak, say, 5 consecutive losses. That's a £50,000 loss, which is a substantial amount, especially if you're not used to managing such large sums. To safeguard your capital and reduce emotional stress, it's wise to lower your risk percentage as your capital grows. For instance, at 0.5%, you'd risk £5,000 per trade. At 0.25%, you'd risk £2,500 per trade. Though these amounts are still significant, the reduced risk offers greater protection for your capital during challenging times. The 1% rule is all about longevity. It's designed to keep you in the game, even when the markets are tough. By adjusting your risk according to your capital and striking a balance between protecting your account and pursuing profitability, you'll be able to trade more strategically and with greater confidence. Money management, the key to trading success. When it comes to trading, money management is the most important skill you can master. Why? Because without careful management of your funds, they can disappear quickly, leaving you unable to trade. And without trading, there are no profits to be made. Whether you're trading Forex, CFDs, commodities, or cryptocurrencies, the same principle applies. Discipline and smart money management are essential. A strong grasp of these principles, combined with clear rules, forms the foundation for long-term profitability. Why money management matters. Skipping proper money management increases your risks and limits your potential rewards. Every trade carries some level of risk, it's just part of the game. But by mastering money management, you stay in the market longer and improve your chances of success over time. Think of it this way: good money management isn't just about avoiding losses, it's about staying in the game long enough to see opportunities turn into wins. The role of rules. Predefined rules are a game changer in trading. They help keep your emotions in check, preventing trading from feeling like a chaotic roller coaster ride. Without rules, emotions like fear and greed can take over, leading to impulsive and costly decisions. By following a clear set of guidelines, you maintain a calm, logical mindset, an essential quality for making smart trading decisions. In the end, it's this disciplined approach that sets successful traders apart. Setting rules for your trading plan. The 1% rule, managing risk in trading. One of the most effective yet straightforward risk management strategies in trading is the 1% rule, limiting your risk to just 1% of your total portfolio per trade. Why is this so important? Because it gives you the flexibility to make mistakes, learn, and still stay in the game. Trading isn't about winning every time, it's about managing losses effectively so they don't wipe out your capital. Let's break it down with an example. If your account balance is $1,000, you risk $10 per trade. If your account grows to $15, your risk increases to $15. If your account drops to $700, your risk adjusts to $7. This approach automatically scales with your portfolio, ensuring that whether you're gaining or losing, you're protecting your capital accordingly. Why it matters? Keeping your risk fixed at 1% per trade does more than just protect your account, it protects your mindset. It prevents emotional decision-making, such as revenge trading or fear-based exits. It keeps you disciplined, ensuring you trade based on logic rather than emotions. However, there's another crucial factor to consider. As your capital decreases, recovering losses becomes harder because smaller risks mean smaller potential profits. That's why managing drawdowns effectively is key, a topic we'll dive deeper into later. By sticking to the 1% rule, you ensure that even a losing streak won't wipe you out. And in trading, survival is the first step to success. Scaling down risk. As your trading account grows, adjusting your risk percentage becomes essential. While risking 1% on a $1,000 account is just $10 per trade, that same 1% risk on a $100,000 account jumps to $1,000 per trade, a significant amount. To better protect your capital, experienced traders often scale down risk as their account grows. For example, instead of 1% per trade, you might lower it to 0.5%, $500, or even 0.25%, $250, to minimize exposure while still capitalizing on market opportunities. Thinking in percentages. Trading is a game of probabilities, not guarantees. By focusing on risk as a percentage rather than a fixed dollar amount, you create a flexible and sustainable approach that adapts to market conditions and protects your long-term success. Successful traders don't just aim to win, they aim to stay in the game. And managing risk effectively is what keeps you playing. Managing your trades. Trade management, the key to consistency. Just like risk and money management, trade management is a crucial part of any successful trading strategy. It's not just about entering trades, it's about having a clear plan for managing them once you're in. Whether it's adjusting your stop loss or locking in profits, effective trade management helps you stay disciplined and consistent. Why is trade management so important? To become a consistently profitable trader, you need to focus on two key objectives. Protecting your profits. Regularly securing profits ensures steady growth in your portfolio. Reducing risk. Markets are unpredictable. Minimizing risk as your trade evolves is essential to safeguarding your capital. How do you manage trades? Here are some key techniques traders use to stay in control of their positions. Trailing stop loss. Adjusting your stop loss as the trade moves in your favor to lock in gains and reduce potential losses. Setting profit targets. Predetermining exit points to secure profits once the trade reaches your goals. Mastering trade management is what separates amateur traders from professionals. By planning your trades before you enter them, you remove emotions from the equation and set yourself up for long-term success. Risk-reward ratios. Understanding the risk-reward ratio. The risk-reward ratio, R to R, is a key metric that helps traders evaluate whether a trade is worth taking. It measures the potential return of a trade compared to the amount at risk, ensuring that each trade aligns with a profitable strategy. How it works. Let's break it down with an example. Suppose you risk $10 to potentially make $50. Your risk-reward ratio is 5R, meaning you're risking 1 unit to gain 5 units. You can also express this in percentages, which is a preferred approach in trading. If you risk 2% of your account per trade and aim for a 6% return, your risk-reward ratio is 3R, risking 1 unit to gain 3 units. Why it matters? A strong risk-reward ratio allows you to remain profitable even if you lose more trades than you win. For example, with a 3R ratio, you could lose 2 trades for every 1 winning trade and still be profitable. If your win rate is 40% but your average risk-reward ratio is 3R, you can still achieve consistent profits over time. By keeping your risk-reward ratio in check, you ensure that you're focusing on high-quality trades with strong potential rewards relative to the risks involved. Smart traders don't just aim to win, they aim to win big when they do. Stop loss. The importance of stop loss and position sizing. A stop loss is one of the most important tools in trading. It protects your capital, prevents excessive losses, and keeps your trading plan on track. But setting a stop loss is only half the equation. You also need to calculate your position size correctly to ensure your risk stays within your limits. How to calculate position size? Here's a simple step-by-step process. 1. Determine your risk per trade. Example, with a $100,000 account and a 1% risk, you're risking $1,000 per trade. 2. Set your stop loss. Example, you decide on a 30 pip stop loss. For Forex markets. 3. Apply the formula. Lot size equals risk amount divided by stop loss size times pip value. This calculation ensures that no matter the trade, your risk remains controlled, keeping your account safe from large drawdowns. Mastering stop loss placement and position sizing is key to consistency and longevity in trading. Risk management isn't just a strategy, it's your foundation for success. There are tools out there that can help you make this calculation. Simply put, stop loss calculator on Google. It will show you multiple sources for calculating your stop loss and the size in which to invest. Let's see how position sizing works with a real example in the Forex market. Imagine you have a $100,000 account and you're following the 1% risk rule, meaning you're willing to risk $1,000 per trade. Your stop loss is set at 30 pips, and the pip value is $10 per pip. Here's how to calculate your position size. 1,000 divided by 30 times 10 equals 3.33. This means you should place a 3.33 lot size trade to ensure you're risking exactly $1,000 on this trade, no more, no less. Position sizing helps you align every trade with your risk management plan, giving you full control over your capital while keeping your risk consistent across every trade. When calculating position size, it's important to understand how lot sizes affect your trade. A standard lot, 100,000 units, 1 pip equals $10. A mini lot, 10,000 units, 1 pip equals $1. And a micro lot, 1,000 units, 1 pip equals 10 cents. For smaller accounts, simply adjust your lot size to match your risk. This flexibility allows every trader, whether beginner or experienced, to apply consistent risk management regardless of account size. Tools make it easier. While manual calculations are great for understanding the process, it's always wise to double-check your numbers using tools like MyFSbook or other online position size calculators. These tools ensure accuracy, especially when trading different currency pairs, commodities, or indices where pip values may vary. No matter how confident you feel about a trade, always stick to your predefined risk and double-check your calculations before placing an order. Protecting your capital is the foundation of long-term success because in trading, survival comes before profits. Trailing stop loss. Locking in profits. A trailing stop loss is a powerful tool that helps you protect your capital while maximizing profits as the market moves in your favor. Unlike fixed stop losses, this method dynamically adjusts to market movement, allowing you to lock in profits without manually closing your position. There's no one-size-fits-all approach. Testing and experience will help you discover the strategy that works best for your trading style. Trailing stop loss strategies. By market structure. Adjust your stop loss based on key swing points in the market. How it works. As the price creates new highs or lows, move your stop loss to the most recent swing point. This method keeps you in the trade during a trend while only exiting if the market reverses significantly. Example, if the price breaks above a previous high, shift your stop loss just below the low of the structure to protect your gains. By price movement. Manage your trade using your risk-reward ratio, R, as a guide. How it works. Once your trade reaches 1R profit, move your stop loss to break even to eliminate risk. For every additional 1R gain, shift your stop loss forward by 1R to lock in profits. Continue trailing your stop until the market hits either your stop loss or take profit level. Why it matters. Trailing stop losses allow you to maximize profits in trending markets while protecting your capital from sudden reversals. They remove emotions from your decision-making, helping you stay disciplined and consistent. The key is to find a method that suits your trading style, whether that's following price action or using fixed profit intervals. In this example, we're looking at a sell trade. After the trade is executed, we begin trailing the stop loss as price continues to break structural levels to the downside. This strategy allows the trader to maximize profits as the market moves in their favor while minimizing risk along the way. By moving the stop loss with each significant structure break, the trade becomes safer over time. If the market begins to reverse, the adjusted stop ensures that profits are protected, or losses are reduced if the market changes direction unexpectedly. However, there's a common mistake traders must avoid: moving the stop loss too early. Doing so can cause the trade to be stopped out prematurely, right before the market resumes in the intended direction. So, it's essential to strike a balance, trail smartly, but give your trade room to breathe. Choosing the right trailing stop-loss approach. The best trailing stop-loss method is the one that aligns with your trading style and risk tolerance. There's no universal solution. What works for one trader may not work for another. Here's how to choose. Higher risk tolerance. If you're comfortable with wider stop-loss adjustments and want to maximize profits, the market structure approach may suit you best. This method waits for significant breaks in price action before shifting the stop-loss, giving trades more room to breathe during strong trends. Lower risk tolerance. If you prefer locking in profits regularly and minimizing exposure, the price movement method with predefined intervals, like moving the stop-loss at 1-hour increments, might be your best option. This approach offers consistent protection but may cut profits shorter in prolonged trends. Test and adapt. Trailing stop-loss methods are not one-size-fits-all. The key to finding the right approach is through backtesting and practice. Backtest each method on historical data. Analyze how it performs across different market conditions. Adapt the method to align with your goals and personality. By testing and fine-tuning your strategy, you'll build a personalized approach that improves consistency and helps you stay in the game for the long run. Drawdown. What is a drawdown? In trading, a drawdown happens when your account balance drops from its peak value due to a series of losses. Simply put, it measures how much your portfolio has dipped during a losing streak, a key metric for evaluating your risk management and overall performance. Understanding drawdowns helps you set realistic expectations and maintain the discipline needed to navigate the ups and downs of the market. Turning drawdowns into learning opportunities. Drawdowns aren't just setbacks, they're valuable signals. They can highlight when something might be off with your trading approach. If your backtested strategy shows a maximum drawdown of 5%, but your live trading reaches that limit faster than expected, it's time to step back and ask yourself, are you following your plan consistently? Has there been a shift in market conditions? Do you need to adjust your strategy to better align with current volatility? The growth mindset. Accepting that losses are part of the process is key to becoming a successful trader. Instead of seeing drawdowns as failures, treat them as lessons for improvement. Every loss is an opportunity to refine your strategy, improve your risk management, and strengthen your emotional discipline. Review your trades, identify mistakes, and adapt your strategy. By maintaining a growth mindset, you'll not only recover from drawdowns but come back as a stronger, more consistent trader. Example. Let's break down how drawdowns affect your portfolio with a simple example. Imagine your starting balance is $1,000 and you risk 1% per trade. Your maximum drawdown limit, based on your backtested strategy, is 5%. If you lose 5 consecutive trades, each risking 1%, $10, your total loss would be $50, bringing your account balance down to $950. This 5% drawdown is your signal to pause and evaluate. So you need to ask questions. Are you following your trading plan? Is the market behaving differently than expected? Do you need to adjust your risk parameters? And act accordingly. Drawdowns in a growing portfolio. Now, let's look at how drawdowns work when your account is growing. If your portfolio grows to $1,100 and you hit a 5% drawdown, a $55 loss, your balance would fall to $1,045. Even though the percentage remains the same, the actual dollar amount increases as your account grows. This is why managing risk consistently is crucial. Small mistakes in larger accounts can have a bigger impact on your capital. Key takeaway. Drawdowns are inevitable in trading, but they don't have to derail your progress. Use them as a tool to analyze your performance, adjust your strategy, and refine your skills. Managing and limiting drawdowns. Every trading strategy will experience drawdowns. They're an unavoidable part of the journey. What separates successful traders from the rest is how they manage and limit these setbacks. The goal isn't to avoid drawdowns, but to control their impact and bounce back stronger. Key steps to manage drawdowns. 1. Know your limits. Set a maximum drawdown threshold that aligns with your strategy and risk tolerance. For example, daily or weekly loss limits. Maximum percentage drawdown, 5 to 10% of your account. Number of consecutive losing trades. Once your limit is reached, it's time to step back and reassess. 2. Review and adjust. Hitting your drawdown limit isn't just a setback, it's a signal. Use it as an opportunity to review your trade journal. Identify whether you're following your plan. Analyze if market conditions have changed. And adjust your risk parameters if necessary. 3. Have a drawdown recovery plan. A solid recovery plan helps you avoid emotional decisions and protect your capital. Your plan could include reducing your risk per trade until you regain confidence, taking a break from trading to clear your mind, focusing on backtesting or demo trading before returning to live markets. Drawdowns are inevitable but manageable. Accept that drawdowns are part of the process, they don't define your success. What truly matters is how you respond to them. By managing drawdowns effectively, you protect your capital, stay in control, and give yourself the best chance of long-term consistency.